You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, this week we have my favourite guest back in the studio. It's Brendon Ptolomey, Managing Director of Heron Todd White. It's been, I reckon, 4 months, Brendo.
Yeah, time does fly when you're having fun. Here we are in May. Are we in May?
Yeah, I was thinking this a couple of days ago. It feels like everyone says this, but the year just goes so fast at the moment. So many things have happened in the last 4 months, haven't they?
Yeah, it is interesting to look back to January, think about what happened in February, look at where activity is in the marketplace, and then contemplate whether we are in fast forward or is this just the new normal, mate?
Interest rate rises, building companies collapsing, building companies shutting doors, boarding up the front gates. All this stuff going on in the last couple of months. Let's wrap it up in this conversation. We're going to add some sense to how the world's been over the last few months and provide some guidance as to where we think things are going and how the last 4 months is going to impact the next 8 months.
Yeah, that sounds great. And just like we have talked about in the past, there are some really conflicting stories around that dent consumer confidence. One of the major ones obviously being interest rate rises and the fact that we've had, 10 in 11 months now. I would expect consumers would probably like to know some of the background information to assist them in making good decisions.
Let's start with interest rates and a commentary on the further after the April pause. I found it quite surprising, still that it was a pause in April. But what I found more surprising was that the industry, including people who were supposed to be quite sophisticated in banks, were nearly putting social pressure on the RBA to say, like, this is it. This is the pause. They must be pausing now. This is it. Rather than trying to predict actually what's going on in the economy and be correct about their decisions, pragmatic. It seemed like the whole world was closing in on the RBA saying, this is it, obviously, right?
Yeah.
Did it feel like that to you?
Yeah, absolutely. That pressure of them to come out and say, this is all over, the storm's finished. We're not in the eye of a storm. We're at the end of the storm. I agree in that we saw a lot of headlines, and maybe this is just the media cycle and media writing an easy story, but there was plenty of articles not around, is that the end of inflation cycle? Are the parameters that the RBA analyse at the end or in the parameters that they want them to be in? It talked more to, I saw more press around things like, right, well, fixed rates now can be just 4.5%. Let's go again.
Fixed rates are dropping.
Yeah.
The fixed rates only drop when banks believe the prevailing rate are going to start dropping so they can make money on that.
Yep.
They wouldn't have dropped it if they didn't believe in their own minds that things are going to start dropping over the next year. And look, it's possible that rates could still drop over the next year. Most banks consider it will. I don't think they're going up willy-nilly on that.
Yeah.
But I just found it really surprising that the whole world sort of just jumped on this bandwagon, convincing themselves to try and convince the RBA that this is it.
Yeah.
And then they're all surprised last week when we had a 25 basis point increase and people were going, what is going on?
Yeah.
And straight away, oh no, that sounds about right. And so, well, hang on a sec, which one was it?
Yeah. Were you correct last month or the month before? And really, I suppose the question will evolve this month as everyone analyses the commentary from the RBA as to whether they think there'll be another rate rise after this. I notice some of the press in the last week or so has been around from economists essentially saying the RBA didn't warn us in their previous commentary that they thought that there was going to be more rate rises
they definitely
coming.
did.
Yeah.
Because what's going on right now is I think Philip Lowe is at pains now to repair his reputation and the reputation of the RBA board, given how misleading their comments a couple of years were, to now jawbone down even further than what reality might be, where they're going to act in the future. So they've been at pains to say, we're doing this one, but we might do more, or we're going to pause this month. We might not pause next month.
Yeah.
So it's really surprising that people thought, oh, that was it.
Yeah, and so then if we link that to consumer behaviour and what our valuers are seeing and hearing in the street, so to speak, from what we can see at the moment, there certainly hasn't been a dampening of consumer sentiment. The demand out there across a number of different suburbs is really strong. It'll be interesting to see whether that now ebbs backwards because of timing, i.e. we're going into colder months of the Perth marketplace and kids' sports back on, those kinds of things. We're back out of school holidays. Essentially, everyone stays inside and doesn't go buying. We'll see what happens. But right at the minute, the stories we're hearing, Trent, are things like in Perth Metro, if you start up in the northern suburbs, Banksia Grove, 43 groups to a home open where the agent actively said to everyone, I'm opening this home once. If you want to buy it, you better come on this day. They got 14
What a
offers.
strategy.
Yeah, absolutely. That's very time
Very
effective.
efficient, yeah.
And got 14 offers out of that process. And the really interesting part about this is the 450 to 550 odd price range, which sits right in underneath that median house price of Perth. So affordability and people out there buying established dwellings in a location where they do have an option to go a little bit further down the road and buy a block and try and build a house. Into a different price point, Wembley, just in the last week or so, seen 10 offers on a house there, where the market sentiment was around the idea that this would go for just under mid-twos. Brand new product in that location. And I think this shows the strength of demand for brand new product in good locations. They'll end up getting high twos for that.
In the absence of any ability to build your own house.
Exactly. Yeah. So there's a premium on the house part of the apportionment of value there. And we estimate that that's going to go for probably 15 to 20% higher than maybe some of the market and the agents had expected in that location.
Records, I guess that would be.
Yeah, so it's heading toward records for that location. Yeah. The other one, again, down Huntingdale Way, so southeast corner of Perth, something that was bought 5 months ago, which was bought at $400K. It lines up with your renovation guest the other week. So they've spent $100K on this renovation and selling it 5 months later at $600,000. And there were 36 groups through that home open and they received 15 offers.
600 grand in Huntingdale, man.
Yeah, sounding strong for my ears.
Yeah.
But then I wanted to just balance this out with another one, just a transaction with one of our team brought to our attention in terms of the higher end of the market and what you were saying about housing stock. So City Beach previously bought in April 2022 for $2.165. We're talking about a big 5x3 Italianate mansion, plenty of arches going on and those kinds of things.
A year ago.
Yep, a year ago, 2.165. It's got a pool and all those kinds of things, and a big double garage and a decent sized block, and that's just resold in February or settled in February for 2.1. So it's really interesting that it's slid backwards or flatlined.
So that's interesting because I've got a close friend of mine, very successful fella, who bought in February 21 in City Beach for $2 million flat.
Yep.
A year later, just change of heart of where he wanted to live in apartment in Cot, sold for 2.9.
Really?
In a year.
Yeah. And so it'd be interesting to compare those two products because this was big family home, probably would need some work on it, would be pretty prime for a bit of a reno. And some people would see that as a project that's too expensive in this marketplace. Obviously, there's some other parts around, why is the vendor selling? Did they need to discount it to get out of there? Those kinds of things. So, yeah, it's just interesting, those different comparisons.
And look, I've heard the same thing. A couple of buyers agents I speak to, and I wouldn't suggest they're shy with their prices at all. Their job in this market, secure assets for their client. I don't think they're really focusing on value. They're focusing on acquisition of particular properties. And they're saying we are getting beaten all the time by 10%.
Yep.
And we wouldn't go that further. And I'm thinking, well, if you wouldn't go further and you're still getting beaten by 10%, there's some serious pressure in that market still. You think about weekly transactions, which is the demand side, obviously. You don't have a transaction without demand. It hasn't changed. We're still hovering between 950 and 1,020. It really hasn't moved from that, Brendon, since the start of the year. And really, for 2 and a bit years now. And you compare that to where it was 5 years ago at 550 a week.
Yep.
And in the last mining boom at about 800 a week. Our demand has never been so strong. And it just is not falling away.
Yeah.
In the meantime, though, supply.
Yes.
I knew you were just like, Trent, I want to talk supply. Holy moly, what's going on?
So this is like, we've been talking about this month on month, each podcast, every quarter, just looking back at these supply numbers and going, gee, it can't get tighter than that, can
Christmas.
It? Yeah, exactly.
We were talking in Christmas and we said, oh my God, it just passed 8,000.
Yeah. Same week last year is 8,025 listings. These are REWA numbers as usual. 4 weeks ago, 7,076. This week, listing numbers down at 6,452. And houses of that, so you're out shopping for a house amongst those 14 people that have offered in the same dwelling that you're trying to buy. There's only 3,080 houses on the market at the moment. Yeah. It's absolutely unbelievable.
And let's break that down for a second. If we're transacting at 1,000 properties a week, we're losing a couple of hundred properties a week off the market. Yep. So only about 800 are coming to market, 1,000 are getting bought.
Yeah.
When does it stop? Because there has to be like a natural line there where you go, we don't have any more houses.
Yeah, and so this is the strange part of this market cycle that we've been talking about for a while, but we get to that stage of, so there's a bit of affordability here, but it also comes back to basic supply of there's no churn in the market because there's a hold up in brand new houses coming out of the ground. So they're not adding to supply. The people that are going into those houses are not selling them anyway. They need them. They're coming out of their rental and their lease is over and their rent's gone up. They need to get into their brand new house. Then those bottom end market is not turning over in terms of those new people going to new houses, not selling them, occupying, staying where they
There's
are.
no mobility, is what you're saying.
Then the next level of the marketplace goes, oh, well, there's no one that wants to buy my house because they're all in their new house and I'd like to go and buy a new house for myself because I want to upgrade. Oh, there's nothing to choose from, so I'll stay exactly where I am.
Yeah.
Yep. And that then just follows up that value chain. Yeah.
So what happens when supply gets critically tight, Brendon, in our economics year 9 class? And demand stays constant.
Yeah. So clearly we would be expecting to see values increase, and I think that's still the portion of this cycle that we haven't definitively seen, and that's why I thought that we'd talk about those numbers of people at home opens, because when we talked about those in previous cycles, those types of scenarios and those stories, there was always a really dramatic value band attached to it, a definitive increase in values where we knew that the median house price would be jumping the next time we saw it come out. There was absolute step change in value, whereas in this market, we're not seeing massive increases across the board. So there's still a lot of competition on those prices, and we're also still catching back up to our kind of median house price. So there's a lot of activity happening underneath the 550 median house price.
So why aren't we seeing step changes in prices, Brendon?
So above the 550, there's a whole lot less transactions, and it's a median statistic, and so the median house price has not been driven up because there aren't enough transactions above the 550.
So you think prices are step changing, but we're just not seeing it because of the way we measure the median?
Yeah, I think we're starting to see that step change now. As people realise that they're in competition with 10 and 14 offers on the same house, that's filtering out into the message out into the marketplace.
You know what's interesting? When you talk about those anecdotes, we had that as a norm in early 2021.
Yep.
Remember that first quarter of 2021? It was mental.
Yep.
It was exactly the same story as you were saying. Maybe slightly even tighter. We didn't have that maybe for the last year and a half.
Yeah.
Well, it's back again is what you were saying.
It's back again. And the bit that we don't know here is why is that activity going up right now?
With interest rates being so high.
Yeah. Have people got comfortable in interest rates? Did they just go last month and go, oh, that's it, the cycle's over, I'll go and buy now? So we'll have to wait and see what happens now that the RBA have gone again. But I would expect that demand and supply, or the supply side of this argument, wins, i.e. there's not enough houses, and so therefore the demand stays as it is or gets higher, and that will drive values up.
I think it's not even so much about a choice. You don't have a choice. You have to live somewhere. And if you can't live at mum's house because you've just emigrated here or because you're 45 years old, you need to buy somewhere or rent somewhere. And you can't rent anywhere at the moment. We know those statistics. There's about 10% of the amount of rentals on the market than there used to be. You can't really rent viably. It's not much of an option for you. You go to buy, therefore you have to pay what you have to pay. That's just what it is right now.
Yeah, so rental listings are at the moment around about 545. 4 weeks ago, 636, and interestingly, same week last year is 580, so a little bit less, but probably my concern around rental side of things is essentially the ability of landlords to be able to put up rents relatively quickly, and just starting to hear some of those awful affordability stories. So on the fringe of the Perth metro area, stories of families having to share houses, so families with multiple kids and all those kinds of things.
Well.
So small houses, 3x2s, that kind of stuff, with 2 or 3 families trying to live in there. That's not a healthy story to hear.
Even when I was on 6PR last week, I had people calling up in that situation.
Did they? Yeah. Interestingly too, the selling days is dropping pretty quickly. So 16 last month, and the lead indicator from REWA at the minute is 12 days to sell as we go from April into May.
That's nearly a natural zero. Because it takes X amount of days to
get
it uploaded, to have a home open, because you're not really doing your job as a sales agent if you don't have a home open. You probably need at least 7 days to get people to have a look at your asset. and then you've got to sign them up over the next day or two. So I would have thought your natural zero is probably 8 or 9 days.
Yeah, exactly. It doesn't matter. Even the settlement process hasn't sped any of that up.
Yeah.
Maybe we've saved a day or two with electronic signature processes and those kinds of things these days on previous timeframes. But I think that you're right. Like, it can't really get that much quicker than that, can it?
No.
Yeah. One of the other trends we just noted in the last month or so in terms of some of the transactions we've seen coming through from a contract to sale side of things is the concept of dual key dwellings. So essentially something that got hammered in value because people didn't really understand the concept in the previous downturn. They looked like they've nearly doubled in value, some of these things. So they were around about the 350 odd K mark. We're talking about locations like Baldivis, Lakelands and Dawesville. And the concept is it's a 3x2 or a 4x2 that's relatively small, and then the same block has got a 2x1 on there as well. So
attached to it.
Yeah. So it can almost be on the same roof as well.
A lot of the time they actually put them under the same roof, make them look like one big home so that it gets approved from planning, because a lot of local governments don't want to approve it. So it looks like one big house, and then there's just a hallway where you put a door in the middle. Yeah,
spot on. And so some investors are buying those thinking, here we go, this is a rental gold mine. I'll be able to get $900 odd a week. And in reality, you're kind of getting more like 300 each way, kind of $600 to $700.
Yeah, I would suggest people listening to
Just
this, whilst it is an interesting property type to look at, it is a very niche market who will ever buy that back off you. It is a niche of an investment market. So yes, it looks great from a front end on the rental yield side, or it looks better. But from the sales side, what's the one property, Brendon, other than old flats from the 60s, that struggles the most? It's the old duplex side by side. Don't get involved in owning those properties if you don't have to, I'd suggest. That's my advice.
It's just really interesting to see people come for that in terms of looking for that outsized return when they compare it to a single residential dwelling.
Let's talk about the building industry.
So
you have your ear to the ground. You have a lot of mates in the industry, Brendon.
Hopefully there's still
as you shuffle around your chair.
Well, I just think it's really interesting that we've had BGC residential home brands essentially shut up their sales shop, so selling 0 more houses for the rest of this year and probably next. I think
just so everyone knows, they're the biggest building company in Western Australia, and they were the biggest in the country at some point. At one point.
And just through sheer size, sheer number of brands that they've acquired over a period of time, that type of thing, they ended up being the biggest in Australia. So at the moment, their statistics are that they've got 4,000 houses left to build, and that they aren't set up to be able to sell any more houses into the marketplace. So they've taken what I think is a pretty dramatic step, and that is that they've shut down their sales division. It's very understandable and very logical. If you can't build as what you've got in your pipeline, then why would you keep putting more into the pipeline? So you can understand their decision.
The whole admin team's gone as well.
So that would have been admin, would have been sales.
Over 100 people.
And we're talking about, so when we're talking admin, that's the people that would have been scheduling contracts, people that would have been doing drafting, setting up designs, altering plans for customers, those kinds of things. We're talking about lots and lots of people that have left that business. I thought it probably would be a bigger story in our marketplace than maybe it has.
Well, maybe there's a reason it wasn't as big.
Who knows, Trent? Who knows why it wouldn't be a big story? But essentially they're saying they've got 4,000 houses left to build, and they'll build 2,000 for each of the next 2 years. So obviously they keep their subbies, they'll keep their building personnel on to manage through those contracts and manage through the construction. So certainly want to make it clear to people that are a customer of BGC that your house is still scheduled to be built. And I would imagine they're probably incentivizing people to stay on that are in those jobs to make sure that construction gets done. So
just don't expect any customer support anytime soon, probably.
I don't know what's going to happen there. And we want to be really careful to understand that this isn't a collapse of a builder or anything like that. They're not in financial strife. They've essentially made their own call to say we're not doing sales anymore now because we're going to complete the construction that we have. And I would have thought that they're a really big diversified business, that they'd be financially sound to be able to do that.
Oh, look, they're worth billions, and they're making what they consider to be a prudent decision to not become the next Porter Davis. To not be that next company that's literally gone broke or into administration, and those thousands of jobs getting picked up by your Dal Alcox, your Summits, your Home Group WAs who will come in and pick up the pieces on a building insurance claim. But there's a real precarious position you have to be in the first place to not be able to support a business that's worth billions, 100 staff through a downturn. That's got to say something, Brendon, because if they were doing fine financially, even if there was little use and they said, look, we're not going to do much selling, you could have redeployed those people.
Yeah, and so it comes back to which capacity do you have in your business, and I think where they probably got really caught here is obviously sold a lot of homes with building bonuses attached, both federal and state government bonuses, and they would have been working on the idea that they could upskill part of their workforce and also bring in capacity externally, whether that be from the East Coast or overseas. That clearly hasn't been as successful as they would have liked. So they haven't been able to scale up their construction capacity, hence where they've ended up with houses to build and not enough capacity to do it.
Do you think when they come out of this cycle, BGC is the same BGC that went into it? Is it a scaled down BGC maybe? Would that reflect many businesses in WA in the construction space where maybe they're actually a bit more pragmatic about their scale going forward?
It's really difficult to project that. I'm finding it really hard to understand in my small business brain how you would restart a business like that. How do you flick that switch and go back to, say, some team members that you've let go?
You've lost all that talent.
As well as your customers, and say, okay, here we go, we're up and we're selling again. Having said that, they've got a lot of really strong brand names that, what do you do? I was just thinking the other day, what do you do with all your display homes? You just lock them all up and walk away and go, right, we'll be back in 2 years.
Because that's the sales office, a display
that
home.
Is effectively the sales office. And if you don't
probably
have
selling them because they probably want the cash, to be honest.
Well, some of them will have already been sold and leased back as well, which
true.
is an interesting concept in itself. From an estate development point of view, you can't have anyone move into those houses. You can't have people in the display living in the display village. It doesn't work. It's not the idea of how the display village works. And so, it remains for us all to wait and see as to whether they can actually start up again into the future. Then if you move from that thought and go, well, if they don't start up, and merely the fact that as of today, there's the biggest builder in single residential builder in Perth is not open for business anymore in terms of sales, then what does that do to affordability in our market, availability of obviously buying either a brand new house or renovating
throughput of new supply. The whole theme of this conversation is supply. They are the biggest proponents of new supply in this state.
Yep.
If they're not adding more supply, there's no pipeline, and they're saying we're not going to have a pipeline. We were the company that had the ability to provide that. Now we're not.
Yeah.
Who is?
Yeah, exactly. And so the slack can't be taken up by anyone else immediately. There might be some people sitting there thinking, gee, I'd really love to be the competitor to BGC. You're going to fly now. Well, it doesn't work that way. The other builders only have a certain amount of capacity. So BGC are saying we're full, we've got 4,000 houses to build over the next 2 years, and the next builders will clearly pick up some customers, but they can't pick up the 2,000 odd per annum that we're sitting there waiting to come to BGC. MBA is saying that we should be building at least 14,000 houses per annum, and
you could argue more than that.
If you go to HIA, they'll be arguing more than that. So just depends on who you want to listen to. But bottom line is that they're saying that our capacity to construct is only 10,000 single residential houses per annum,
which is what we were building 40 years ago.
Yeah.
So where did all the trades go?
It's a good stat. Far out. Yeah. Well, and so then you come back to the macroeconomics of the WA economy and go, so where did the people go? We haven't had a lot of people leave the state.
We haven't had a net loss. You know how in the last 6 years, the market's obviously dropped, and you go, well, a big proponent of that is a lower population. The population never dropped. It just didn't rise at the median increase we usually have. And we had a huge overrun of supply coming out of the last building boom. Supply lags demand, and we had years and years of low population growth trying to soak up an oversupply, which is funny to, obviously, ironically, we're in the exact opposite position now. We've got continual demand that is unabating because of immigration, and it was always going to happen coming out of COVID, and no capacity to provide that supply, and the biggest proponent of that supply now saying we're not going to do it anymore. And one thing we haven't spoken about as well, which governs the capacity, like it or not, of every builder in this state, is QBE, who are the building indemnity insurance provider, the only building indemnity insurance provider in this state. And I know for a fact they are limiting the hell out of every single builder's QBE, from the small guy to the big guy, their book, essentially. So that you could have a small builder who's going, I'm doing really well, I'm pricing right, I'm financially viable, and a QBE going, nah, not going to increase you. So even if they wanted to, the industry currently can't provide more because QBE won't even insure it.
That's a real concern, and that definitely is something that the government would need to step into.
They're paying out of their ass at the moment with all these building companies going down. Why would they want to increase the book of all these builders?
And take on more risk.
That's right.
I was just checking the HIA numbers in comparison to MBA. They're saying we require 20,000 homes.
We do. Our long run average is about 2,000 a month, 24,000 a year, right? We've been starting about less than 1,000 at the moment.
Yep.
That's where the gap is.
So if you can get a building contract, Trent, is it as straightforward as going and building a house in terms of trying to make a return on property at the minute?
Yeah, so in the construction space, I would suggest you want to be focusing on that small to medium builder who doesn't have too many projects on the go, who clearly know their stuff, who've got a good decade of experience in the game, who demonstrate the builds they're doing. You can check the quality, all those things you normally want to do, but you should be able to ask, where is your building indemnity insurance cap sitting at? Is it going to affect the throughput, the timing of our development? Because I've seen builders who sit on projects, which is, BGC is probably one of them, because they're capped out on their liability more than anything for that year, how many starts they can start in the year. Make sure you check that with a smaller builder. But the feedback I'm getting right now is, one, the builders who are building, there's obviously not a lot of competition in that space, so they're increasing their margins. They're now running at 25, 30%, when pre-COVID, just to get work, they were running at 15%. So it's costing you more. And they're also trying to get, I guess, some of that profit back that they lost when they were genuinely losing a bucket of money over the last couple of years.
Yeah, the Qantas effect. I'll just crank prices.
It is literally the Qantas effect going on right now, And then obviously all the trades are still operating at very high prices or record high prices. Some of those trades are dropping, the front end stuff, the wet trades like your brickies, your slabs, these guys have dropped. And their availability is much more normalized right now. So the builders I'm talking to are boasting to me that, look, I'm really sorry about that one that went for 17 months, but we're confident if we start today, we could do it in 9 months.
Yes, well, I'm hearing similar things, good. In particular from a couple of the biggest builders. So they really confident about finishing what they've got. They've also keep commenting on the fact that they think their quality is pretty good, and then that supply of materials that restriction on supply of materials is over, and that they're into a more normal phase again. So it's pretty interesting from that point of view. The other thing,
but you're paying through the nose.
I was just going to say exactly that. So if you have been looking to build or are looking to build, and you're looking back at old prices, say you have built previously, or you had a prior to COVID or prior to building incentive quote on construction, then move on from it, because those prices aren't
never
coming
happening
back.
Again.
They're never going to happen again.
I'm 33, Brendon, and I have the privilege now of being able to say, I can't believe this. Back in my day, when I built my first 4x2 in Dutch when I was 19, you know what the turnkey contract was for? It was with Home Buyers Centre.
Oh man, I can't work that out off the top of my head, but were you at 120 grand or something like
150 turnkey.
Oh, it wasn't too bad.
You weren't too far off, right? So that was 14 years ago. That I signed that contract. 14
that is
years,
unbelievable.
We've now seen what is effectively a 250% increase in cost. Now that is the underlying reason, in addition to demand and supply, but is the underlying reason why established housing prices are rising and will continue to rise. It is the replacement cost theory to assets. If the cost of replacing the asset in the market is higher than the prevailing cost of the established asset, the established asset's price must increase to the cost of the replacement cost. Otherwise, no more supply will come on. It's basic demand and supply. Right?
Absolutely.
That's what's happening in this market right now. So suddenly, these houses that are 4x2s that you've been depreciating on your valuations for the last 20 years to say, well, look, it cost you 150 to build. It's probably only worth 90 now. It's probably worth 250 now.
Well,
because of the replacement
dilemma.
Right. So to rebuild that Canning Vale 4x2, that's 250 square meters with the theatre and the study, those massive 2000s homes that were built, right? That would have cost 100 something grand to build. They would cost 400 grand to build.
Spot on.
So how do you write that into your valuation?
So we used to have some rules of thumb, so to speak, where you'd be doing your summation method of valuation. So that's essentially what's the land worth plus the depreciated value of the improvements. And we've had to throw that concept, the summation still works, but the concept of it is almost thrown out the window. What you do have to remember is that each time you're doing that as the market moves, we are increasing the cost of construction. So that effectively is meaning that if we do the replacement cost of that building today, we're using the new higher rate per square metre, we're still going to depreciate the house, but it might mean that the depreciated value of that asset is higher than what it cost to build it originally, which does make your head spin around a bit.
Well, it's the first time in my lifetime where I've seen that. I don't know about you.
No, absolutely. It's the first time.
Makes your job pretty tough.
It does. It's like we're really smart.
The maths goes out the window a little bit.
It does, because so then if we are in those newer suburbs right across Australia or just around suburban Perth, and you're sitting there, you can see the land sales down the road. So we do our direct comparison on that underlying land value. Even if you're in an established suburb, you can see that the older houses being bought and knocked over. then you can stand back and say, okay, that land value is X dollars. Then you go down the road and do an established dwelling and go, okay, well, I really know the underlying land value is X. How can the improvements be worth X dollars? And that's where we analyse that market.
Here's a straight question. People will be asking you. You asked me about what a client for a new build be thinking. I'll ask you on the other way. When they go to put that to you for evaluation for the bank, you're looking at a brand new building, Canning Vale. The land was $420,000, which is prevailing price for a 400 square metre block, surprisingly these days in Canning Vale. And they have a $400,000 build contract they put in front of you, $820,000 plus stamp duty. They've sold their house 20 years older, but double the size for the same price. How are you justifying that?
Yeah, so we will obviously be doing some direct comparison on that. In terms of doing a finance valuation on that or any valuation, we want to find our most recent sales evidence of the new product so that we can say, okay, new product in that location is selling for X, and how does that compare to what we would call the as if complete valuation on the subject property? Then we would be looking at the difference between those two. And then we'd also go back to the old one and go, okay, that old one actually is established, it's got established gardens and lawns and patios and pools and those kinds of things. Here we are with a brand new product. So how do they compare in the marketplace?
There's always going to be a first, though.
Yeah.
I feel that valuer is nearly hoping they're not the first, because then they can just look at that guy down the road who approved that valuation, and then you just stand behind that, because the first one's never going to be able to justify it.
Well, we would have to go to neighbouring suburbs then and still look at whether the market is happy to pay that type of value.
Because at the end of the day, you are trying to justify what is the most critical part of evidence, which was the transaction.
There's
and still two willing parties here.
We could also be going back and saying, look, we think that's overcapitalised and the construction cost is too high for that location.
Do you think that's going to happen in this market with rising, escalating costs and prices?
It will happen in certain locations, and as we've always said, people need to be making sure that they're building the right house product for the location that they're building in. So don't go and buy the most expensive single residential house brand and then put it in the mid-tier section of a subdivision, because it's just not going to stack up. Interestingly, we're hearing from the land developers that there are a fair number of cancellations within their estate. So essentially we're seeing the idea of people that were going through the scenario that you're talking about, i.e. we have picked our house. We've now picked our block of land a while ago. We've been waiting for that title to get ready or the documentation to be prepared on the house. When we made these decisions around value and what we can afford, we were able to afford those repayments. Now our circumstances have changed. We've come to the time of getting finance approval. The valuation gets triggered by the bank and we go out there and do our valuation. But essentially the customer's turning around and saying to the bank, oh, hang on, because interest rates went up, I cannot now afford the repayments on what would be built on that block of land. And luckily those people can go back to the land developer and say, hey, look, can I cancel the contract and maybe I can buy something cheaper and make the numbers work for me?
It's a conundrum everywhere, though. This is not a land-specific issue.
No.
It's a construction
issue as well. Yeah, they go hand in hand.
The land's fair price, I think.
We don't think any of the land really in general across Perth Metro is overpriced. It usually stacks up from a val point of view. And most importantly, from doing a valuation point of view, we can see the market come and buy those cancelled contract blocks. So they've got a title on them, they're ready to be built on straight away, and they'll transact again for the same or more than what they transacted for previously.
Blessing in disguise for the developer sometimes.
Yeah, absolutely. Yeah.
Let's quickly, if we can, project out for the next few months before you're back in again. Where do we think winter's going to look? Do we think, quick shooter on some stats here, demand, will it be the same, lower or higher per week?
I think it'll go up. Yeah. I think there's enough immigration happening into WA to put pressure on demand.
Do you think that we will rise above 7,000 before we drop below 6,000 in supply?
Where's the rebound coming? I just can't see where the supply is coming from at this point in time. So it's hard to see that we would flick into I'm being facetious, but an oversupply before we get out of the undersupply between now and when we talk again.
Okay. Interest rates? Interesting one.
I haven't. If you had asked me prior to this one increase, I would have said there's one more increase coming.
Yeah.
But now that they've done it, and the RBA are talking about the idea that inflation isn't under control to their liking, there's plenty of economists that say that inflation peaked back in December last year in terms of looking at their parameters that they like to monitor. I would expect there's probably another rate rise in there to peak out rates.
That's an interesting point, because it starts to talk to the ability for price to grow, which is the next question. Obviously, median house price, mid-500s, depending on who you ask. That's the home. The house is in the 600s. the
Yep.
units somewhere in the 400s, but the median dwelling price is in the mid 500s.
Yep.
A year ago, I made a forecast that I'm going to stick to my guns on, that by the end of this cycle in Perth, our median house price will hit the 700s.
I'm a valuer, Trent. I don't like making these crystal ball predictions, but it's really difficult to see how we don't track in that direction as long as we get more transactions above the median house price at 550, because that will statistically drag us up. I'm just being really pragmatic about that. But how can we be more affordable or have a lower median house price than, say, Hobart and Adelaide? It just doesn't make any sense when you compare the economies of those two locations compared to us.
Yeah, well, that's where it doesn't work from a really holistic point of view. And normally, and we say this often, when things don't make sense in a market, there's generally a very logical answer that will eventually prevail.
Yeah, absolutely. Yep.
Brendon, it's been fantastic having you in.
Great
for
discussion,
our
mate.
May chat. It's been very dynamic today. I love it. Thank you very much, and look forward to speaking to you about regional markets soon.
Yeah, cheers. Thanks for having me, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!